There are many ways to categorize the stocks that make up an index. Often it's done by industry or sector. But there is an additional way to categorize stocks using attributes that illustrate possible behaviors and performance. Those attributes are called factors. Factors are attributes that help explain a stock's long-term risks and returns. Low volatility and momentum factors have gained the most attention, but research demonstrates that each factor has periods of underperformance and outperformance. Evaluating multiple factors together is useful in adapting to a wider variety of market conditions. Pacer ETFs teamed up with Lunt Capital Management on the Alternator ETFs, an ETF series that uses relative strength to rotate between multiple factors. The Pacer Lunt Large Cap Multi-Factor Alternator ETF, or PALC, divides the S&P 500 into the low and high side of 4 factors: momentum, quality, value, and volatility. These factors are reevaluated monthly using relative strength, so the index can gain exposure to the 2 top-performing factors. Pacer ETFs also offers this strategy in the mid-cap space through the Pacer Lunt Mid-Cap Multi-Factor Alternator ETF, or PAMC. This uses the same rules-based process, but within the S&P 400 index universe. The Pacer Lunt Alternator series gives investors dynamic exposure to factors that rotate to adapt to changing market conditions, all through a tax-efficient ETF. To learn more about the Alternator series or Pacer ETFs, visit www.paceretfs.com or talk to your financial advisor. An investment in the funds is subject to investment risk, including the possible loss of principal. Pacer ETF shares may be bought and sold on an exchange through a brokerage account. Brokerage commissions and ETF expenses will reduce investment returns. There can be no assurance that an active trading market for ETF shares will be developed or maintained. The risks associated with this fund are detailed in the prospectus and could include factors such as alternator strategy risk, calculation methodology risk, equity market risk, ETF risks, high portfolio turnover risk, large capitalization investing risk, new fund risk, non-diversification risk, passive investment risk, sector risk, tracking error risk, and/or special risks of exchange-traded funds.